You ever look at a successful company and just wonder, how does that whole thing actually work? It can feel like this super complex machine, right? With a million moving parts. But what if I told you there's a universal language that takes all that financial chaos and turns it into a clear story? Well, today, we're going to learn to speak that language. So, that's the big question, isn't it? How does a business tell its financial story? How does it communicate its health, its performance, so that anyone, you, me, an investor, can actually understand what's going on? Well, the answer lies in a powerful, standardized set of documents we call financial statements. So what are these things? The absolute best way to think about them is as the official report card for a business. Seriously. They don't just give you a final grade, they show all the work. They reveal exactly where a company is acing it and, where it might be struggling a bit.
Okay, for the official definition, financial statements are a standardized set of reports showing a company's financial performance and position. Now that word, standardized, that is the absolute secret sauce here. It means everyone is playing by the same rules. It's why owners, investors, even banks can look at these reports and get a clear, trustworthy picture of the business.
And believe me, when I say a complete picture, I'm not kidding. These statements show you a company's financial position, basically what it owns versus what it owes. They break down its performance. Did it actually make a profit or a loss? They even track every single dollar to show how cash is flowing in and out of the business. It is the whole story, from the big, splashy headlines down to the tiniest details.
All right, so that's the big idea, but now let's zoom in a little. See, a set of financial statements isn't just one document. It's actually made up of several core reports, and each one tells a different, crucial part of the company's story. Before we dig into the reports themselves, you gotta understand this one critical concept: timing. Some reports are like a snapshot, a financial photo taken on one specific day, like, say, December 31st. But others, they're more like a video clip. They show you all the financial action over a whole period of time, like a month, or even a full year. Getting this difference is absolutely key.
So remember that financial snapshot? That's the statement of financial position. You'll often hear it called the balance sheet. And on one single day, it gives you this perfect, frozen-in-time picture that balances what a company owns, its assets, against what it owes, its liabilities, and what's left over for the owners, which is the equity. It's a perfect freeze frame.
And now for that video clip. This is your statement of income. This report tells the story of a company's performance over a period of time. It adds up all the money coming in from sales, the revenues. Then it subtracts all the costs of doing business, the expenses. And that final number at the bottom reveals the big finale. Did the company make a profit or did it end up with a loss?
Our video also has the statement of cash flows. And listen, this one is so important because, and you should really remember this, profit is not the same as cash. A company can look profitable on paper but have zero money in the bank. This report is like the detective. It follows the actual cash, showing exactly where it came from and where it went, breaking it down into operations, investments, or financing.
And finally, there's the statement of changes in equity. The easiest way to think about this one is that it tracks the owner's piece of the pie. It just shows how their stake in the company grew or maybe shrank over that period of time, usually because of profits the company kept, or new investments, or maybe dividends that were paid out.
And I really can't say this loudly enough. Please, whatever you do, always read the notes. If the main statements are the headlines, the notes are the full story. This is where you find all the crucial context, the definitions, the policies, everything. The numbers tell you what happened. The notes are where you find out why. Okay, so we have all these reports, but who makes the rules? How do we know that everyone is preparing them the same way? Well, that brings us to accounting frameworks. If financial statements are a language, then these frameworks are the grammar. They're the rules that keep everything consistent so we can all understand each other.
These rules didn't just appear out of nowhere. They have a really long history, evolving from the very first ideas of double-entry accounting way back in 1494, all the way through the 20th century as Canada developed its own standards, leading to the solid frameworks we rely on today. Here in Canada, it really just boils down to two main sets of rules. First, you've got IFRS, that stands for International Financial Reporting Standards. This is the big, complex, super detailed rulebook, and it's mandatory for all public companies. Then for private businesses, there's ASPE, Accounting Standards for Private Enterprises, which is a much simpler, more streamlined option. So we've got the reports, and we've got the rules. But who actually needs to prepare all these formal statements?
Let's take a look at how this all plays out for different kinds of businesses right here in Canada. Well, the requirements are different depending on the business. For public companies, it's a definite yes. It's not optional. They must prepare formal statements. For private corporations, they usually need them for filing taxes and to keep their banks or lenders happy. And for small sole proprietorships, they might not need these super formal statements, but they are absolutely required by law to keep good, proper records for the CRA.
It's also really important to know that not all financial statements get the same level of professional checkup. Think of it like a ladder of confidence. At the very bottom, you have a compilation. That's where a CPA just puts the numbers together but gives no assurance they're correct. A step up from that is a review, which gives you limited assurance. And at the very top of the ladder is a full audit, which gives you the highest level of assurance that the numbers are solid.
Okay, we've gone through a ton of the what and the how, but let's zoom back out and talk about the most important question of all. Why? Why does any of this matter? Well, it matters because these standards, these rules, they are the very bedrock of a healthy, functioning economy.
At the end of the day, it all comes down to building trust, and that trust is built on 5 key pillars. These standards give us consistency and fair presentation. They demand transparency. They allow us to actually compare one company to another, which is comparability. And when you put all that together, it lets everyone make truly informed decisions, and that is the engine that drives a market economy.